Johansen, and I'm the marketing manager here at Coface Nordics. And I'll be your host for today's session. So today we will talk about something that has become increasingly important in today's environment, how to detect risk early and before it turns into a real problem. So in this session, we will start with a global insolvency outlook. We will see how real-time insights can support better decision-making, and we will look at cases and give you a live demo. So before I introduce our experts, some practical information. The webinar will run for about 1 hour. There will be a Q&A at the end, so you can type in your question and send it to us at any time. Just click on that question mark on the top of your screen. A chat will open and you can send in your question. We will record the session, and both the recording and the presentation will be made available for you after the webinar. So joining me today, I'm happy to introduce Jonathan Stenberg. He's economist at Coface, and he will start us off with the latest global insolvency forecast. And we have Simon Blank, which is head of business information. And Simon, he will take us from macro to practice. And we have Gabriel Islaim, deputy lead business information. And Gabriel will guide us through a live demo and have a look at KYC. So with that said, Jonathan, stage is yours.
Thank you very much. I will quickly share my screen here. Well, it's great to have everyone joining us today. It seems like every morning we wake up to new news, both oil markets, financial markets, and our general stress levels seems to change depending on the tweets coming in. So before I focus specifically on what we expect from insolvency forecasts, I also just want to set the scene a bit. Where is the world at the moment before we sort of highlight how we believe this will impact companies and therefore the development for corporate insolvencies. So where are we right now? Well, the world is uncertain, to put it mildly. We have seen an increase in uncertainty, particularly in the last 6 years, in which it seems like a new crisis happens basically every 12 months. We went from COVID to supply chain issues to energy crisis to cost of living to high interest rates, Red Sea disruptions, trade wars, and now war in Iran. That has all happened in the last 6 years. So these are very, very tumultuous times. This has a big impact on companies on several different levels. One is the big one that's often talked about. If you want to make an investment, you'd like to understand the way the world looks. But we've really gotten to a point where this amount of uncertainty makes you question, where am I going to sell my products? Can I sell them tomorrow? The suppliers I've had for a long time, are they still going to be there? Will they be able to provide me with the goods I've been receiving? So this level of uncertainty has gone from sort of the level we're more used to a now a level where it actually questions some of the operational natures of companies. And it is currently, as I like to say, the only thing we're certain of is that we will be surprised. And the amount of changing tweets we get every day really just cements this for us. So what is some of the key worries that we currently have? Well, one of the key ones is obviously around commodity prices. As you can see, after a easing period for a longer time, as you can see on the left-hand side, we've now seen a re-emergence of prices within commodities. Initially, we saw it pick up for non-energy commodities, and in the past few months, we've seen energy prices really, really pick up. You can see this on the one-hand side. Unlike the previous crises that we saw after the invasion in Ukraine, this is for the time being more centered around Brent oil. So oil is the big kicker, to a lesser degree natural gas storage. It should be said though that that's also seen quite a significant increase, but not to the same level as we did before. However, we are still in a period in which we need to rebuild up our storage, which means we do expect these prices to continue to be elevated for the foreseeable future. Even if the conflict ends very, very soon, we will still have a big amount of storage that has been eroded, and we need to build up that buffer again. That basically means even with some demand destruction, we still have an underlying fundamental increase in demand that comes from simply building up storage that will push up energy prices. And that's even if the conflict ends tomorrow. Some analysts, which might be the pessimistic ones, say that in the time period which is realistic to really get back to the storage level we had pre this conflict would be in 3-4 years' time, which means basically we have a few years of having to build up more and more energy capacity in order to have the same amount of buffer that we did beforehand. So what is the second key change that we've seen since the war in Iran began? Well, one of the ones is that the outlook for interest rates has completely changed. We went into this year being somewhat optimistic that we probably would see a significant amount of cuts from the US. In the euro area, we were probably looking at an unchanged level for the remainder of 2026. Potentially with some change in 2027, but for this year at the very least, everything looked quite benign. We were looking at an easing cycle after a longer period of very, very high interest rates. That has completely changed now. US, we're looking at either an unchanged amount, as you can see, potentially fears around whether there could be an increase. In the Eurozone, after expecting none, we're now looking at markets expecting a significant amount of increases this year. We're not sure we'd buy into the whole story of that many hikes, but we are probably looking at a world in which some hikes will be necessary. So fundamentally, we're looking at a world in which before we believe we'd see easing inflation. We also believe we'd see an easing interest rate environment, which is now both completely reversed, especially when we're looking at the second half of this year. So we've started to operate in a world again in which we basically say there are different kinds of scenarios. Our main scenario is one in which there will gradually be some sort of agreement, maybe not a complete reopening, but essentially we'll probably see energy levels about 50% higher than we're expecting in the beginning of the year. That would take it around the 90 on average for the whole year. That's 90 USD per barrel. Significantly higher natural gas prices, and again there'll be some needs to gradually start restocking. We'll probably see energy rationing in some countries. Again, something to keep in mind with these kind of crises is that for a advanced economy, the main impacts here will be higher prices, lower growth. But if you're looking at emerging economies, they will see rationing. They will potentially see shortages, which will have a significant impact, not just on their day-to-day lives, on the operation of the businesses, but potentially looking at social unrest if food prices start picking up significantly as well. And again, as you saw earlier, with the expectations for fertilizer prices starting feeding into food prices in the latter half of this year and the beginning of next year, that is expected to start having an impact at that point. We're also operating with two other scenarios. A more optimistic one, which again, if a deal is found today, and they manage to really quickly reopen the Strait of Hormuz, agree on everything, basically, we might see a smaller impact. It would still be a global slowdown compared to last year, but it would be a smaller one, and we would probably be looking at a world in which central banks do not need to do anything. We also have the more adverse scenario. This is the one in which the conflict re-intensifies. We start seeing bigger impacts on particularly energy infrastructure, and we'll see disruptions around supply chain issues that are worsening, and we will see production shut down initially mainly in emerging economies, but that's starting feeding into advanced economies as well, which we'll see in particular increases in costs across the board, not just for the particularly commodities impacted by this crisis. So what is the medium-term outlook? Well, it's stagflation 2.0. We would argue we're already in a stagflationary environment, but now it has intensified. We expect an underlying inflation to remain higher. We expect GDP growth to be lower than we've been used to for a long time. We expect fundamental financing to be higher than used to, and we expect volatility, this uncertainty, to remain higher than it used to. And this is, again, not just our short term, this is our medium term expectations. We are six years into periods of a lot of volatility, a lot of uncertainty. It does not seem to change anytime soon. And what is the main impact then on companies? I think the easiest way is to ask them themselves. This is the PMI service coming out after the crisis, and we very much agree with the main sentiment here. We expect future output to go down. Basically, people will sell less in the next month. We expect them to increase prices simply because they have to. That might sound like a pretty okay environment, increased prices, potentially higher margins, but as you can see on the right-hand side, the expected increase in costs in input prices is expected to increase far higher than the ability to pass these on, which basically means we are seeing a further period of margin suppression in several companies. This will be more severely impacted in certain regions. Europe is a key one here, and certain sectors. I've here taken manufacturing as a whole, but we can find pockets of manufacturing which are particularly sensitive to this period of margin suppression that we expect to see. So where do we expect insolvencies to go? They are already at their highest level since 2013. As you can see, since a lull period after the 2019 and government intervention, low interest rates and massive amounts of liquidity being shot into the financial system meant that insolvencies fell down, but then started rebounding. From 2023 onwards, they've started increasing further and further. This is particularly accelerated in Asia Pacific and Europe, but in North America, we're now also seeing it pick up as well. This was mainly the US keeping these down as the US economy continued to do relatively well. But to put this into perspective, in Q1 2026, insolvencies in the US rose by about 20%. They are now catching up to the rest of us as well. And what is the outlook then for 2026? Well, we started this year believing it will rise by about 3%. That would still have been significant given the fact that we are already more than 25% higher than we were before the pandemic. But it was again a clear slowdown compared to what we'd seen in the past few years. Now we expect it to rise by around 6% again. That is roughly equivalent to what it did in 2025. This will be more significant in certain countries. Across Europe, we expect a continued increase, particularly so in Germany, in France, and in the Netherlands, with a slower increase in Italy, Spain, and the UK. We'd argue that Spain is a bit of an outlier here, as a slower increase there is due to still a relatively strong economy. In Italy, this is a large degree because companies are company creation is generally falling, which means a increase here is more significant than it is in other countries. And in the UK, it's in part due to the fact that insolvencies are already very, very high. So it's a base effect, basically making sure it doesn't increase higher. In North America, you can see where one of the key drivers of higher insolvencies is. It's the US. We expect it to increase by about 8% this year. And this will start getting a lot worse if we're looking at a prolonged crisis here. One thing that I think people are sometimes surprised by is that when you look at GDP figures for the US, it still looks pretty okay. And people have said, well, it's this K-shaped economy. You know, the richer households are doing relatively well. They have their savings. They can still spend money, whereas the poorer households are struggling more. The exact same thing is true for companies in the US as well. The bigger ones with the really strong balance sheets are still doing really well. They're investing in AI. They are seeing, generally speaking, really strong figures coming out quarter after quarter. But if you look at the small or the medium-sized companies, these are really struggling. Business creation is low, insolvencies are high. They have had an inability to pass on the cost of higher tariffs, which some of their larger competitors have been able to through either stocking early or finding ways to get around some of these increasing costs, which means it's disproportionately hitting them harder. In Canada, we expect a bit of a slowdown here. This is once again similar to the UK because it's coming from a very, very high level. Canada saw a completely different trajectory than their peer to the south. And Japan, we expect insolvencies to continue to rise by about 7%, whereas in Australia, which, to be fair, has seen insolvencies rise almost as much as Canada, we expect them to continue to increase around 3% again this year. This is again an upward revision of around 3.5 percentage points compared to what we expected in the beginning of the year. And lastly, and I want to highlight this, if we're looking at the more adverse scenario, if we're looking at a crisis that continues to be prolonged, then we expect this increase in insolvencies to be even higher. I think I'll stop here and hand over to Simon, who can educate you guys even more.
Thank you very much, Jonathan. Let me quickly share my screen. All right. Yeah, thank you very much, Jonathan. Yeah, as you can see, and I guess that was not a big surprise, we are living in very exciting times, and that is why it is increasingly critical in today's volatile environment to detect risk earlier before it becomes a real problem. But before we dive into the topic, let me briefly introduce Coface. Coface is a global leader in credit risk management, supporting companies worldwide. We are talking about 100,000 customers, actually over 100,000 customers across around 200 different markets. And we manage a global exposure of more than 700 billion euros. So we help businesses grow safely by providing solutions in different areas. I guess the most famous one is the credit insurance topic, protecting companies against non-payment. Another area where we help clients with is business information, the sector I'm responsible for, where we deliver high quality data and insights on companies worldwide. And the second key area is the third key area is debt collection, where we support recovery when things go wrong. In some selected markets, we also offer factoring and some other solutions. But the core of everything we do is one simple idea, and that's helping companies make better, safer decisions when they trade, especially when it comes to assessing risk. It's working. We had now, you got now a quick overview of Coface as a company. The question is, what makes our business information actually different? And more importantly, why does it matter when it comes to detecting risk earlier? The challenge we see across many organizations is that risk doesn't behave in a static way. Financial health of a business partner, compliance exposure, operational issues, or even broader market dynamics can change very quickly, sometimes within weeks, sometimes within days, or sometimes within hours. But most companies still rely on static assessments. For example, annual reviews, financial statements, one-off checks, and so on and so on. The reality is that those views are often already outdated the moment you use them. So what's really needed is a more dynamic approach, moving from static reports to what we would call live business partner intelligence. And the idea behind it is pretty simple. It's like a traditional financial report is useful, but it helps you or it tells you what happened in the past. What you actually need is a continuously updated view, combining those financials with real ongoing market signals. And that's where Coface is fundamentally different, because we don't just produce data, we use it ourselves to take risk decisions every single day. Through our credit insurance business, we are directly exposed to payment risk across hundreds of billions of euros of trade globally, which means we have real skin in the game. When we assess business partners monitor changes or detect risk signals, this is not theoretically. These insights directly influence our own underwriting decisions, our risk appetite, and of course, ultimately, our financial exposure. So we really take that into consideration when we do decisions. And this fundamentally changed how we look at data, of course. So we don't just collect the information, we also constantly challenge it, we validate it, and we enrich it with real world experience. Oh, one too fast. So what does it actually mean in practice? At the core, it is about beyond static financial data and adding real life world signals. So what you can see in the middle of the circle, that's what you are used to. That's the common thing. It's like an annual financial report. It's a financial statements and so on and so on. And we combine all that with, like I said, like live data, real world signals. To give you some examples, and I'm not talking only about non-public data, we add also payment behavior, claims and default experience, debt collection insights, country and sector risk assessments, and also qualitative information, qualitative analysis, including direct market feedback. As you can imagine, especially on the insurance side, we are nonstop in contact with our clients, with the market, to collect information, to interview CFOs, and to get all the information. And as we are doing that for a very, very long time already, we have a huge database that is also giving us historic data on how claims are doing, and so on and so on. And this data is not static. Like I said in the beginning, in the last slide, we are continuously validating that, we connect that, we enrich that by analytics, but also by our risk experts and our global network. And the result at the end is not one report. It is a dynamic, evolving view on business partners' risk profile. And again, this is the critical factor here, because live signals, they tend to change before the financial statements do. So instead of reacting late, you gain early visibility, and then, of course, more time to react. I would like to show you some examples, 3 examples to show you where or how we are able to see risk at an earlier stage. We prepared 3 cases. All 3 cases, by the way, are from the Nordics region. Just to explain the slide quickly, what you see in the middle, or not in the middle, but on the left side, this white chart, this is showing our score. So on the left side, you can see 0 to 10. 10 is best, 0 the worst, and you can see the development of the score. Of course, we have more than just the score. There is a lot more that we show, like the credit limit and so on and so on. But that is something that we will show to you later. This is just to make it a little bit more visible when I explain the use case to you. Everything else you will see at a later stage. So this first example here comes from the renewable energy sector. And at first glance, this company showed very strong growth in 2025. And that's even though we were in are in a weakening market environment when we are talking about that sector here. But when we looked deeper, our data revealed that this growth was largely driven by a backlog rather than a sustainable demand. And at the same time, we identified early warning signals. So for instance, we saw that there is a declining in the profitability due to rising costs. We saw weak liquidity, and we also saw an increasingly fragile financial structure. And based on these combined signals, our assessment already pointed at this a mismatch between operational performance and financial resilience. As the situation developed into 2026, those early signals materialized. Financials got worse. Dependence on external external support increased, and ultimately the company was classified as insolvent, as you can see at the very end when it goes to 0. The key point is here is that our system did not react to the insolvency, it anticipated it. Already in November 2025, the recommended exposure, unfortunately you cannot see that, you can only see that we dropped the score by 1 point. But if you would look in our system, you would also see that the recommended exposure was reduced to 0 more than 5 months before the actual default. And this is exactly the value of real-time multi-sourcing intelligence. It's giving you time to act before the market fully realizes the risk. And here, way before new financials got published, I mean, there are still no financials for that company, by the way. But before that, we already saw the risk here based on all the data that we collected and that we combined. The next example I would like to show you is from the packaging, paper and packaging sector. In this case, the company initially appeared relatively stable. The score was maintained based on interim financials, expected support from a financially strong owner. However, when we combine different data points, the picture started to change here as well. So in that case, we, for instance, observed that we have payment irregularities, increased irregularities. We saw declining in transparency about financial performance and a growing gap between expected and actual shareholder support, also based on interviews and so on and so on. These early signals triggered a downgrade in our score and led to enhanced due diligence across exposures. What's important here is that the market narrative was still relatively positive. There was an expectation of turnaround and continued backing from the owner, but our data told a different story. So the situation continued to get worse, and ultimately the company filed for insolvency. The key takeaway here is that early warning does not come from a single signal, at least not all the time. It's often a combination of different factors. And that's why it is important to look at different factors, not only on financials, for instance. And in this case here, it was a combination of payment behavior, financial data, and real-world observations that we got back as a feedback. And by acting on those signals early, it was possible to reduce the exposure well before the default occurred. And the last example that I would like to show you is from the construction area sector. Here it is showing you why or how risk can build progressively over time, and why continuous monitoring is critical, something that of course you can do in our systems. As early as 2024, the company showed clear structural weaknesses, losses, a weak equity base, a strained financial structure. And even at that stage, our assessment already included a recommendation to consider reducing the exposure. In 2025, the situation did not improve. Financial performance remained weak. The stability depended largely on the support from the parent company. And throughout this period, the score was not static. It was adjusted multiple times during the year. As new information became available, for instance, reflecting changes in financials, because we are not only looking at the financials that they publish, we also get data from our clients, for instance, directly through the insurance business, for instance, or other risk signals or other data that we get from the insurance business. And that gives us the opportunity to adjust the score all the time based on the combination of data that we can do. And this is a typical situation that we often see where a company appears stable externally, maybe because of like the financials that they published 2 years ago, but is in fact dependent on ongoing financial support from the shareholder, for instance. And in early 2026, in this case, the situation escalated. We saw concrete payment defaults we saw an increasing operational issues and the worsening of the financial position. At this point, the recommendation was very clear from our side: reduce the exposure to zero. The key takeaway here is that risk does not appear overnight, at least not all the time. It builds step by step. And if you monitor continuously, you can act at multiple points along the way, not just at the end. And this is exactly how early risk detection turns into real risk mitigation. To make it a little bit more practical, we would also like to show you how our system looks like. So I would like to hand over now to Gabriel. He will show you a bit the system and will explain you what else we can show you in our database. Gabriel, are you here?
Thank you, Simon. I'm here. Just need to start sharing my screen. Here you go. All right. So far we've been talking about why early risk detection matters and how risk actually evolves much faster today than most organizations expect. Now, what I want to do is to show you how this worked in practice, and I want to make it very concrete for you, because ultimately the challenge is not lack of data, it's how you turn that data into decisions. And that's where Urba 360 comes in. Urba 360 is our global risk platform. It gives you a full view of customers plus suppliers based on both the financial data that we have in the company, but also real trade behavior, all in one place. You can see Urba 360 as a platform guiding you through 3 different layers. First, we have the descriptive part through our full report Urba, which gives you a complete understanding of the business partner you're dealing with. It's not only financial statements, but structure, ownership, payment behavior, and different key ratios. Second, it's predictive, and this is where it becomes powerful. Here you start seeing signals before they show up in financial reports. For example, changes in payment behavior or insurance exposure that typically move early. And finally, prescriptive. And this is where the real value comes in. You don't just get insights, you get a clear recommendation, which is basically what Coface as a trade credit insurance company is willing to take risk on the company aspect today. And that's through our credit opinion. So it's really about closing the gap between insight and action, which is often where organizations struggle. And when you go to the platform, everything is designed to simplify complexity. You get this 360 view of a company where all different risk dimensions are brought together. So we're basically putting all of our expertise in a specific company in one page. Instead of going through different pages of reports, you immediately see where things are stable, where there are warning signals, and where you need to keep track of something. What's important here is that it's not based on just static data. It's combining global data, credit insurance insights, plus our expert analysis into one page. So it's a very simplified interface built on very deep intelligence. We have all the different layers of the wheel. We have the score, the credit opinion, financial ratio, sector, and country risk assessment, plus the late payment index. And what sits behind the 360 view is a combination of different layers of analysis. You have the probability of default over the next 12 months, which is one of the core elements included in our score, which I will deep dive into in a couple of minutes. You have our credit opinion, which gives you credit limit recommendations up to 1 million euros and dollars. So we can choose the currency you want to have. You have the financial data, you have our late payment index, country risk assessment, and the sector risk assessment. And when you combine all of this with the country and the sector risk, you're not just getting a company snapshot, you're getting a complete risk context of how the company is doing. And that is exactly what allows you to detect risk earlier, not just understand it after the fact that something has happened. And I want to deep dive a bit into the score, which is, I remember I've been at Coface now for 3 years, and I remember my colleague, he mentioned in one of our first meetings, he said, it's our Coca-Cola recipe. And that is basically something that sums it up very well. All of the different components into the ERBA is actually translated into this element, the Coface score. It's a scale from 0 to 10, globally standardized. You will always see you'll always see 0 to 10, where 0 represents very high risk and 10 very low risk. The score reflects the profitability of how a company will do within the next 12 months. And it's a predictive score. So it shows you, what do Coface think that the company will do? How do we think that they will do in the upcoming 12 months? What matters most is not the number itself, it's how it changes over time. Because those movements are often driven by real world signals, not just financial reporting cycles. So if you see a decline, even before financial deterioration is visible, that's your early warning. And that's what's give you time to act instead of reacting late. So as we can see, we have the scoring, we have the probability default, but we also have the scoring history on a specific company. So how did Coface, as a trade credit insurance company, change the score on this specific company over time? Gives you understanding of how are they actually doing. And before we jump into more depth of how it actually works, I want to show you quickly on how you can actually work in ERBA. So I just need to stop sharing for a second. And I'll get you back right now. Great. So we're continuously doing improvements of ERBA. So whether you are already a user of ERBA or not, or if it's the first time you're seeing it, this is something that we are launching right now. I want to show you how it actually works in practice. So first of all, you have a very good view of all of your companies. You can see whatever company you've placed into monitoring, and you can see everything in a list. And if you're like me and you like Excel and you like to have everything very clearly in front of you, you can export everything to Excel. Very simple. And what makes it great is that you can receive a very, very good and very user-friendly analysis of your portfolio. So let's say you want to see how your domestic companies are doing, you want to deep dive in a specific country, or you want to see how we're doing internationally. Obviously, you will choose the default country you have before you start working with ERBA, but what makes it great is that you will have a full overview of how all of your companies are doing in your portfolio. So let's say you see that you have 282 high risk companies. You want to deep dive into those companies. So if I click on the high risk, then automatically I will see what companies I have there. And this is where you need to keep track. This is where you need to actually act on the companies in the portfolio. Let's say I want to add some more filters to only high risk. What we are doing then, and what we're doing right now, is that you can actually add several criteria into your filter. Let's say I want to see only companies from a specific country, from a specific NACE code, or whether there's been an update, scores from between 1 to 3, or only, for instance, companies from Germany. Then I pick that, I apply my filters, and then I have all of my high-risk companies in Germany in front of me. And let's say now I want to create a different portfolio. Let's say we are a multinational company working with different both clients, suppliers from from departments all over the world. What I can do then is that I can actually create an own portfolio based on the filters that I've added. So I want to create this specific portfolio with French suppliers, for instance, and it's all of our suppliers located in France. Create that. After that, I want to, once again, add France as a filter. And let's say now that I want to add a specific number of companies. Maybe I don't want the full 85. Maybe I just want 5 of them, or you can just select all 85, add to the portfolio. And let's say now I have a specific set of users I want to add to this portfolio. These users will only have access to this set of the portfolio. They will not be able to see anything else. They will only receive notifications on these companies in that portfolio. So I grant them access. And then myself as an admin, I will have the full overview. I will be able to see all of the different sub portfolios plus the big portfolio that we have created. In the ordering part, when you're actually creating an order, you will be able to choose, and this is what I will come to in a couple of seconds. So this is what it looks like when you're actually placing an order. And then, like I said, in the ordering process, you have the possibility to actually click, I want this company to be in the French suppliers portfolio. So let me jump back again to the other part. I just need to stop sharing again. Sorry for jumping back and forth. All right. So one of the most powerful elements is monitoring. And in reality, risk management is not something you do once. It's continuous. With Urba 360, every company in your portfolio can be monitored automatically. System scans for changes across all key indicators, financials, payment behavior, risk score, and all the different components you have in your Urba. Whenever something changes, you get a notification. You get a ping in the system, you get an automatic email sent to your dedicated email box, or every user will receive an email on the changes. And that is also something you can navigate. You can have specific users only receive the monitoring. You can have a shared mailbox if you would like to. You can choose whatever notifications you want to have. Notifications from a specific set of countries or a specific set of companies only. Instead of checking on a day-to-day basis, you're informed immediately. You can rest assured knowing that Coface will take care of the risk for you. And this is critical because early signals can appear at any time, not just when reports are published. So it shifts. The whole approach goes from reactive to proactive. And I want to show you one more thing, which is actually something we're really proud of. We've so far only focused on financial and operational risk, but today that's not enough. You also need to manage compliance risk, things like sanctions, politically exposed persons, or adverse media. And this is where our integration with LSEG's World Check 1, London Stock Exchange, this is where it comes in. World Check 1 is a global screening solution that combines risk intelligence data with automated screening software. By integrating this directly into Urba 360, everything is brought together in one platform. So instead of switching between systems, you can assess financial risk and compliance risk side by side. And you should see this as a completely new layer of insight. You can screen companies and individuals against global risk databases, including sanction lists, PEPs, watch lists, or adverse media. More importantly, it helps you understand connections. So you can identify links between entities, ownership structure, or individuals that can expose you to risk. And this is especially important in complex supply chains or international business relationships. So it's not just about detecting risk, it's about uncovering hidden risk that is not visible in our financial data. And what makes WorldCheck particularly strong is the depth and reliability of the data behind it. It's used globally by financial institutions and large organizations to meet KYC and anti-money laundering requirements, combines human research with technology, with hundreds of analysts maintaining and updating the database continuously. You also have advanced matching algorithms which reduce false positives significantly. And that's important because one of the biggest challenges in compliance is noise. Too many alerts that are not relevant. And here the goal is to make screening both accurate and efficient. So instead of spending time with filtering results, you can focus on the cases that actually matters and act faster. So to sum it all up, if I leave you with one key takeaway in today's environment, it's not enough to understand risk. You need to act on it early. And what Urba does is simplify very complex by combining real-time data, clear risk signals, and actionable recommendations in one place. And with the integration of compliance through WorldCheck One, you're not only assessing how stable a partner is, but also how safe they are to do business with. So in the end, it's not just about better data, it's about better decisions, faster decisions, and ultimately avoiding risks before they even become visible. And that's really the power of detecting risk early. And with that, I would like to give the word back to Mona.
Thank you so much, Gabriel, and thank you to all our experts for sharing their insights. We are now at the Q&A, so all speakers can turn on their camera. We already have a few questions in the chat. I will answer the first one because it's about the distribution of presentation afterwards. And yes, you will all get the presentation. The next question is, how do you get data about changes in companies' payment behavior? And I think that's for you to answer, Simon.
Yep, I can do that. Yeah, so here again, and I think that was also the overall message that we shared in the presentation. We do not rely on public or static information here. Coface generates payment data from real trade activity. So first of all, through our credit insurance business, now we see actual payment behavior, claims, defaults across hundreds of billions in global trade. Now, like I said at the beginning, we have an exposure of over 700 billion euro, and therefore we collect a lot of data through that. And second, we also capture real payment experience from transactions. So how company actually pay, not just what they report, but like what we can see through the insurance business. And then the third pillar, I would say, is the debt collection pillar. So we can collect all the cases that we had in the debt collection business unit, and we can see also all the cases that are overdue. And at the end, it's a combination of everything here that we also enrich by our global network and our risk analysts and partners.
Thank you, Simon. So I think also the next question is for you, and that is the score comparable across countries or industries, or does it mean different things?
Yeah, I think Gabriel took that point a little bit. So we
Yeah.
have the same score everywhere. So what you will see is always the score from 0 to 10. It's comparable. It's one unique way of validating companies. So yes, you can use the score worldwide, and you can use it to integrate it, for instance, in your global ERP system or whatsoever.
Yeah, and next one is, do you have a pool of info shared with other credit insurers, or is it only Coface data? For instance, payment performance or overdue account notification. I don't know, Simon or Gabriel, which one who wants to answer that?
Yep.
Sorry, can you just take the question again?
Yeah. Do you have a pool of info shared with other credit insurers, or is it only Coface data? For instance, payment performance or overdue account notifications.
Good question. So what's shown in, for instance, the late payment index, if that what's the question is referring to, it's only what Coface knows. It's only what we're not a global pool of all the different trade credit insurance companies, but it's only what Coface knows. However, we're looking 60 months back in time. I actually saw my notes now. So a side note, everything, because I wanted to mention this because it's a question I receive on a daily basis. Everything that you get through Urba is, of course, available through API. So we can deliver everything to you through API. And once you have it on API, if you want to have API on, if you want to have both platform and API, they will be reflected, both of them. However, to add, sorry, Mona, if actually you want to see global claims, then you have them in the full report Urba.
Thank you, Gabriel. So next questions. How do you avoid alert fatigue when monitoring hundreds and thousands of companies? Gabriel, Simon, one of you.
I think it's a quick answer here. So if you have the portfolio view, you can use different filters and you can tailor your notifications to make sure that you only see what you're really interested in. So there are different possibilities, settings that you can use to avoid that.
Okay, thank you. So I think that is all we have of questions for now. No more questions in the chat. Oh, here it comes. What's the role of AI in Urba?
I was waiting for that question to come. Simon, do you want to start or?
Go ahead.
So to start off with, the most important thing we have is development. We know that the world is moving super quick. We know that AI is a super hot topic right now. Our score, our Coface score, has AI embedded in it. So it's actually learning from previous decisions, basically. So I would say that it's something that Coface is looking into very much. We are developing AI into all of our different components into Urba. However, as it is more, as we are a trade credit insurance company and we have our skin in the game, it's important to understand that the human interaction creates a very, very big difference as well. So we cannot only rely on data as such, but I mean, when I say data, I mean AI. We need to understand that it's a combination of both.
Yeah. And but of course, all the decisions that we are doing on a daily basis, that is something AI also can learn from. That's
Yes.
what we are investing in, developing in. And so yes, I mean, I'm pretty sure that's an important topic for almost all companies, but especially in a world where you speak about data and so much data, and everything can change all the time. It is super important to use that opportunity, and I think it is also a very big opportunity for all of us to detect risk earlier and faster. And like Gabriel said, the combination here is making the difference.
Mhm.
Thank you for that, Simon. So I think we are at the end of the webinar now. If there are more questions, everyone is welcome to contact Simon or Gabriel direct or their account manager in Coface to ask more questions. And thank you again to Simon, Gabriel, and Jonathan for sharing your insights. And thank you to everyone joining us today. Wish you a good rest of the day and see you next time. Bye.
Thank you. Bye-bye.
Thank you.